Hello everyone, my name is Elliot Yu. I'm the founder and publisher of the Creating Wealth Advisory. And today I want to address a very common question that I've been receiving from readers in this short video presentation. And it has to do with the bailouts we've seen for banks, both here in the United States as well as around the world with the Credit Suisse bailout just last weekend. And in particular, a lot of readers are wondering whether the Fed might be quantitative easing again, whether we might be seeing another round of QE, and therefore whether it might be time to buy stocks. Here's what I think. I think this is actually the opposite of quantitative easing. And I'll show you why in just a moment. This is actually tightening. We're actually seeing the opposite of stimulus, and I think this is going to accelerate the already likely decline into recession for the US economy this year. And I think another leg lower in the bear market that we saw starting in the beginning of 2022. In fact, I still think the S&P 500 is going to get down to around the 3,000 to 3,100 range at some point this year in 2023. So what's going on? Well, many of you might have seen this chart last week. It was all over the media. And this is actually a chart that comes from a weekly report released by the Federal Reserve on Thursday evenings. It's called the H4 report. And what it does is it details the state of the Federal Reserve's balance sheet. And this particular chart is a chart of assets held by the Federal Reserve. Now, why is this important? Well, this is important because assets held by the Federal Reserve is how we've traditionally tracked quantitative easing. One of the main assets on the Federal Reserve's balance sheet is securities that it owns. Now, quantitative easing is a process by which the central bank purchases in large quantities securities, mainly treasury bonds and mortgage-backed bonds. And normally with QE, the central bank will announce something like, we're going to buy X billion dollars worth of treasury bonds and X billion dollars worth of mortgage-backed bonds every month. They target a specific amount of bonds that they purchase. So these bonds show up on the Fed's balance sheet right here in the form of an increase in the assets on the Federal Reserve's balance sheet because these bonds it's purchasing are assets. And you can see here on this chart that we had a major round of quantitative easing, as many of you know, from early 2020 all the way up until April of last year, April of 2022. So the Fed actually bought $4.8 trillion worth of bonds, which caused the assets on its balance sheet to go up, as you can see on this chart. However, since last April, the Fed has actually been doing the opposite of quantitative easing, quantitative tightening, allowing bonds that it owns to mature and roll off its balance sheet. The total there was about a little over $600 billion, $625 billion or so between April of 2022 and March 1st of 2023. But look what happened last week here. The Federal Reserve's balance sheet jumped by $300 billion. So a lot of people looked at this and thought, well, the Fed's quantitative easing again. However, bonds that the Fed buys in a quantitative easing program are not the only asset on the Fed's balance sheet. Another major type of asset on the Fed's balance sheet is loans. Now, I know that might seem a little weird, right? Why would a loan be an asset? But this is true of all commercial banks, as well as the central bank, the Fed. The deposits that you and I make at our local bank, for example, are a liability for the bank because they have to pay that back to you on demand. Loans that bank makes, credit they extend, is an asset because the borrower is supposed to pay back principal and interest over time. So the Fed makes loans and it shows up as an asset on the balance sheet. Now this big jump in assets at the Fed, which everybody was looking at last week, a lot of people were talking about, well, this is QE. It was actually a jump in loans made by the Fed. Okay, so there were really three different areas of lending that we saw an increase in, a major increase in. One was what's called the primary credit facility. Another one is what they call other credit, kind of a catch-all phrase. And the final one is a brand new program that they started up just last week called the BTFP, the Bank Term Funding Program. So let's deal with each of these in turn. Primary credit was formed when the Fed was formed way back in 1913. And basically this is a way for banks to go to the Fed and borrow money on a 90-day term, for up to a 90-day term. Now to borrow this money, they have to pledge collateral, which is usually treasury bonds or mortgage-backed securities, so riskless basically credit or riskless basic securities. and they pay interest. In this case, right now, it's 4.75% roughly they're paying to borrow money from this primary credit facility. Now last week, and this is the most important change on the Fed's balance sheet, it was over $152 billion borrowed on the primary credit window, which is sometimes called the discount window. You may have heard that. And you can see on this chart, right, that's more than was borrowed by the banks back in 2020. And it was even more than was borrowed by all the banks in the United States back during the 2007 to 2009 Great Recession and financial crisis. The second program I mentioned, the BTFP, Bank Term Funding Program, very similar to the primary credit facility, but allows the banks to borrow for terms of up to a year, okay? So there is some take up there, almost $12 billion in the last week, but it's still relatively small, obviously, compared to that $152 billion plus in primary credit. Now the jump in other credit, which was about $142 billion in this most recent week, that has to do with Fed lending to the Federal Deposit Insurance Corporation. So basically when the FDIC seizes a bank, as they did with SVB, Silicon Valley Bank, as well as Signature Bank last week, they borrow money from the Fed during the process of resolving the assets of the banks that they seize. So again, where does this money come from? And is it quantitative easing? Well, let me back up here for a second and say that the money is being created out of thin air. So the Fed is effectively printing money to make these loans. That's how the Fed works. When they want to make a loan, they simply electronically create the money. So they are printing money, but is it stimulus? Well, think about what quantitative easing is. When the Fed performs quantitative easing, when they buy bonds, there are really two avenues of stimulus here. The first avenue of stimulus is by buying bonds, they reduce the interest rate on bonds generally. So when you buy a bond, the price goes up, the yield goes down. So historically, the Fed has only controlled short-term interest rates, the Fed funds rate. But by using QE, they can buy longer-term bonds as well and depress the yield on all sorts of securities of all maturities. Now, the benefit of that from the Fed's perspective is that most loans that you take, mortgages, auto loans, credit cards, business loans, they're all benchmarked in one form or another off the Treasury curve. So by depressing yields, they lower the yields, they lower the cost of borrowing, and theoretically that stimulates economic growth. The second avenue of stimulus for QE is they buy these bonds. And when they buy these bonds from, say, a large bank like JP Morgan, they credit JP Morgan's reserve account at the Fed with the money to purchase the bond. So that basically creates, again, money printing out of thin air, a deposit in the banking system, a credit in the banking system. And theoretically, ultimately it could be a credit on JP Morgan's own account. It could be a credit on a customer's account if they're selling that bond to the government on behalf of a customer. Or it could be that maybe a regional bank owned that bond ultimately and they're just using JP Morgan to clear the trade. But it's going to show up somewhere in the banking system, that deposit. Now obviously cash on reserve, right, or deposit somewhere in the banking system is what banks use as the basis for lending. They take in deposits and they lend back out credit, right? They make loans. So when the deposits go up, the amount of lending in the economy can go up, and that stimulates growth. But that's not what's happening here. In fact, neither one of those avenues of stimulus are happening here. What's happening here is that you want to think about the US banking system as really two different areas, if you will. There's the core, right, which is the Federal Reserve, the central bank, and then the very big, globally systemic, important banks like JP Morgan, Citigroup, also Bank of America, Wells Fargo, names like that, the biggest banks. That's the core of the US banking system. And there are only a few of them. If you look at the next level out, you have sort of the periphery, and that would include literally hundreds of regional, local banks, credit unions all over the United States. So you have the periphery and the core. Now, the core of the banking system, the big banks and the Fed, have a lot of transactions among themselves, right? So the big banks are required actually to hold a lot of capital on deposit at the Federal Reserve. They have higher capital requirements. They're considered too big to fail, so they have higher regulatory burden. and they transact a lot with the Federal Reserve directly. The periphery, less so. Now, regional banks often do have some money on deposit at the Federal Reserve, but it is relatively small compared to what a big bank would have, both, of course, in absolute terms, but also as a percentage of their assets. So they have less day-to-day transactions with the Fed. So when you're looking at the Fed's balance sheet, for the most part, you're looking at the interaction between the Fed and the core of the financial system, not the periphery. The problem in this current crisis is the periphery, mainly, and that is the regional banks. And what's happening is that because of the collapse of Silicon Valley Bank, Signature Bank, Silvergate, and Credit Suisse, which is not a US bank, obviously, you have a lot of depositors in these regional banks who are saying, deposits are only insured by the Federal Deposit Insurance Corporation up to $250,000. If I have deposits on a single financial institution above that limit, then I'm not insured. And so I could literally lose my money if that bank fails. And more than 90% of depositors at Silicon Valley Bank were uninsured. And that very tense weekend, you might remember, a lot of those uninsured depositors were very worried. A lot of them were businesses, for example, that they wouldn't be able to make payroll because they couldn't get access to most of their funds held at that bank. So what's happening is a lot of these customers from banks all over the United States on the periphery, the regional banks, are taking their money out of the regional banks and moving them to the big banks, the JP Morgans of the world, where they're theoretically safer. Even though JP Morgan deposits are also not insured above $250,000, it's widely thought that because these banks are so systemically important, that they would be bailed out, depositors would be bailed out at those bigger banks. Also, they have much higher capital requirements and regulatory burden, so they do have more capital that they can use to make depositors whole if need be. So what the problem is that deposit flight from these regional banks to the big banks, right? And so the problem with that is that if you're a regional bank and enough of your depositors come to one of your branches or electronically try to transfer money out of your bank, take deposits out, withdraw deposits, you may not be able to meet that liquidity. You probably have some cash, maybe on deposit at the Fed or in short-term investments that you can use to meet withdrawals. Beyond that, you could sell assets that you own, like longer-term treasury bonds, but you have limited liquidity to meet those withdrawals. The problem with selling assets that you own is that, Silicon Valley Bank tried to do that right before it collapsed. And that problem with that is that when you do that, it's kind of like throwing blood in shark-infested water. Everybody starts to realize you have a problem if you have to quickly dump your securities portfolio, and it can actually exacerbate the run on your bank in particular. So what the Fed is doing through this primary credit facility and this BTFP facility is they're lending money to the regional banks, right? That the regional banks can use that money to pay their depositors without having to do a fire sale on securities that they own. So the banks are taking the securities they own, the bonds that they own, and pledging them to the Fed as collateral and receiving money at a 4.75% roughly interest rate right now that they can use to pay their depositors. But that really doesn't end up being new deposits in the banking system, because what's happening with those deposits is the regional banks are seeing withdrawals. That money's being deposited at the big banks in the United States. So deposits at the larger banks are going up, deposits at the regional banks are going down. Overall deposits in the banking system aren't really doing much of anything. Now, what's crucial here to understand is that the only reason that we're seeing this activity right now is that because the Fed is making a loan, the second they make a loan, right, to the regional bank, that suddenly shows up on the Fed's balance sheet. So normally the Fed has very little relationship with the periphery of the financial system with these regional banks, but the second they make a loan, shows up as an asset on their balance sheet. But that's not really new money in the banking system. It's just money that's being moved from the periphery to the core. And as it moves to the core of the banking system, it starts to show up on the Fed's balance sheet. Now, here's the problem. As I said, There are two avenues of stimulus for quantitative easing. One is that by buying bonds in quantitative easing, the Fed pushes up the price and pushes down the yields, stimulating the economy. Well, in this case, the Fed isn't using that money that it's creating to buy bonds. It's making loans based on collateral that the regional banks have. So it's basing loans based on portfolios of securities the regional banks own at a 4.75% interest rate. So that avenue of stimulus where buying bonds pushes down yields doesn't exist in this case. How about the second avenue of stimulus, which is that by buying bonds, the Fed creates reserves in the banking system. That also, I'd argue, doesn't apply. In this case, there's no new reserves really. As I said, it's moving from the periphery of the financial system to the core of the financial system, but you're really just shuffling deposits and reserves within the banking system between different financial institutions. You're not really creating much of anything. And in fact, I would say that this is more like quantitative tightening than it is quantitative easing. And the reason is this. Think about those regional banks. If you're a regional bank president and you're experiencing deposit flight and you have to go to the Federal Reserve to borrow money to meet deposit withdrawals, do you think you're going to turn around and take the proceeds of that loan from the Fed and then lend it out to people? You're probably so scared about these deposit withdrawals, you're going to tighten up credit standards even more than you have been over the last 6 months, which is there's been a lot of tightening we can see across the financial system in terms of lending standards to all sorts of businesses and consumer lending. So this isn't making you more likely to lend out money. The other thing is this, right? What does a regional bank do? I mean, at its heart, every bank is in the business of taking in deposits and making loans. And the idea is that you pay your depositors a lower rate of interest than you receive on the loans that you make, right? So you pay your depositors in savings account a small amount and you make loans at a much higher interest rate. Now, the regional banks have actually had very low deposit rates. I think the national average savings account, as of the most recent FDIC numbers, was something like 0.35 or 0.4% annualized. So if you have money on deposit at a regional bank, you're probably not earning much interest at all. And so the problem with this is that those deposits are fleeing, right? And so the regional banks are replacing those deposits with loans from the Fed, which carry a 4.75% interest rate right now. So they're shedding deposits that had a very low rate of interest, right? They're having to meet deposit withdrawals, and those deposits only yielded, they only had to pay, let's just say 0.35, 0.4% on those deposits annualized. And they're replacing that capital with a loan that actually they have to pay 4.75% on. So there's a squeeze, right? Even though the interest rates they're charging on loans has been going up as the Fed has been hiking interest rates, the amount that they're paying for capital is also going up because of their need to replace deposits with loans. So if you're a regional banking president and you see your profit margin squeezed, are you really going to want to go out and perform more lending? Probably not. Probably quite the opposite. You're probably going to get very, very defensive, and I think that's exactly what's happening right now. So the result of all this is a tightening of credit at the regional banks. Now, you might be wondering, well, what about the large banks, right? The regional banks are shedding deposits, the large banks are getting deposits. Well, here's the thing. Large banks don't want the deposits. In fact, large banks in the US have been trying to shed deposits for a few quarters now. The reason being is they already have way too much money on deposit at the Fed as reserves. And the more money they have on deposit at the Fed, the higher their capital requirements actually are, the way that they're regulated. In addition to that, what we've seen is that most of the lending in the last few quarters has come from, especially to small, medium businesses and small and medium-sized businesses and consumers, has come from the regional side, not the big banks. So the big banks are focused more on lending to larger companies, traditionally. So in the end result of all this, I think, is going to be quite an extreme tightening of credit. This is going to accelerate trends that are already underway, regardless of how much money the Fed ends up lending out to these regional banks. In addition to that, even if the Federal Deposit Insurance Corporation extended an unlimited deposit guarantee, I don't think that's necessarily going to help the situation that much, because it might stop the deposit flight from the regional banks, but they're still going to have to raise the rate they pay depositors to attract additional deposits back to their institutions. A lot of investors are, instead of putting their money in their regional bank, they're using money market funds, or they're just buying treasury bills, right, that have a very attractive yield. Those regional banks are still going to have to pay up, even if the deposit flight issue slows down. So all told, this is actually, even though it might look like quantitative easing on the surface, dig a little deeper, it's actually not stimulus at all. It's quite the opposite. So thank you very much for listening to me today. I hope you found that useful. If you'd like to find out the moves I'm making in the Creating Wealth Advisory to deal with this mess that we see in the global economy right now, and to protect your portfolio from what I think could be a vicious final leg of this bear market, I encourage you to click the button below the video and take a risk-free trial, 60-day risk-free trial to my Creating Wealth Advisory at the lowest price we've offered in a very long time. So again, thank you very much for listening to me today. I hope some of you will take me up on that risk-free trial offer. Thanks again.